Get set for very rapid economic recovery in the UK. That's the prediction from Bank of England Deputy Governor Ben Broadbent, who's forecasting consecutive quarters of rapid economic recovery. However, in this new interview with The Telegraph, Broadbent also warns that inflation could prove to be less predictable. In this video, let's take a look together at some of the highlights from this interview as we look ahead to what he calls a noisy and bumpy economic recovery this year. Hi everyone, I'm Martin Bamford, a chartered financial planner, personal finance YouTuber and money author. On this channel, I talk about personal finance, investing and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, click on that little red subscribe button to become part of our subscriber community. It's completely free and you'll never miss an episode. The Telegraph interview starts with Bank Deputy Governor Ben Broadbent lamenting the difficulty in finding somewhere to eat, an issue I'm sure we're all familiar with at the moment, as this rush to get back to outdoor dining and drinking, combined with some pretty decent weather, has made it much harder to secure restaurant reservations. But getting a table is a pretty insignificant challenge relative to the policy-making issues faced by Broadbent and his colleagues at the Bank of England as we move into the next phase of this economic recovery following the COVID pandemic. In this article, it explains that, along with his colleagues on the Monetary Policy Committee, Broadbent is faced with a delicate balance of supply versus demand. That demand side comes from the significant amount of pandemic savings accumulated during the past 12 months. Bank of England chief economist Andy Haldane has put a figure of £150 billion on those cash savings. Others think it could be higher still. The £150 billion question then, will people be willing and able to splash that cash, pumping it into the real economy at such a pivotal time in the recovery process? Broadbent is apparently edging towards Haldane's view on the strength of the expected recovery, although he doesn't share the idea of a coiled spring when it comes to pent-up consumer demand for mass spending. Broadbent is, however, more bullish than most of his MPC colleagues. He thinks that people could spend more than 5% of their COVID savings. 5% is the central forecast for spending of the COVID savings. He's more bullish because that central forecast dates back to last May, and since then, of course, we've witnessed a big rise in consumer spending back in the summer when lockdown measures were then eased. While it could be too early to make a call on a so-called roaring 20s scenario, Broadbent is forecasting very rapid growth, at least over the next couple of quarters. One factor driving that very rapid growth is people saving less money in the coming quarters, as well, of course, as spending some of that excess cash savings from lockdown life. He adds, the burden of proof, it seems to me, should be as to why that wouldn't happen rather than why it would. So I have tended to be on that more optimistic side. On inflation, he says there has been less of a disinflationary effect, and that's because household spending has largely switched to other areas, for example, from leisure and entertainment to supermarket shopping. Inflation is still well below the Bank of England target of 2%, despite rising in the past month. Broadbent said in the interview the price rises for those hitting capacity limits are going to be bigger than the falls in prices for those seeing falls in demand. He says that understanding price inflation signals is going to be the biggest headache for the bank because, according to Broadbent, it's going to be quite noisy and bumpy this year. One reason for that noisiness and bumpiness is the comparison to inflationary slumps that we saw last year, which will amplify price rises this year. He said, when you get the shift in demand, you're going to run into bottlenecks in some areas, particularly in those areas where supply too has been hit for a particular reason. You see it in some traded goods, in IT equipment and chips, for example. You could see some bumpiness in prices, particularly on the goods side. That makes our life a little trickier because monetary policy has to look ahead a couple of years. On interest rates, Broadbent shares my view that negative interest rates will not be necessary. He says later in the interview, I would want to be confident that it would be passed on. He's also wary about rising interest rates too quickly. I find that one particularly interesting because within a matter of months, the interest rate narrative has rapidly shifted from negative rates to a rate hike. In reality, I think we're most likely to see rates on hold for the time being and then lower rates for longer than many expect. I know the financial markets are pricing a rate rise by the end of next year. I can't personally see that happening by then, but time will tell. Broadbent then turns his attention to what might happen after this initial flurry of activity as the economy reopens. There's talk in the article about the bank's forward guidance, which stresses that inflation must be hitting the 2% target sustainably before rate hikes take place. And again, that reinforces my view of low rates for longer. Turning back to the dining metaphor he used at the start of the interview, he says, you and I can't get a restaurant table, so they put their prices up. How long is that going to last if in 3 months they're able to open their indoor space and we can ring up and get a table the following day? There is this wider question about this balance between the pace at which demand and supply come back. Broadbent then turns to another elephant in the room, which is the furlough scheme, coming to an end in September and likely to be followed by rising unemployment once those jobs are no longer protected by the government. He also refers to government fiscal policy as orders of magnitude more important at the moment because deficits have reached record peacetime levels and the bank has been buying up bonds like crazy, expanding their programme of quantitative easing to £895 billion. The bank is still buying up £4.4 billion worth of bonds each and every week. That's keeping yields very low. Later in the interview, he says that QE could go even higher in the future if needed, but he thinks the overall toolbox is less important than the primary question of what you want to do with the stance of monetary policy. Responding to the Office for Budget Responsibility, which has warned this QE policy will result in much higher costs to the taxpayer once interest rates eventually rise, he says the bank has been making this point for years and that a quarter point rise in interest rates might add a couple of extra billion in public spending of around £1 trillion a year. This is not that big a deal, frankly. It really isn't. He also says the fact is the government is now more highly geared than a year ago. And the main reason for that is not QE. The main reason for that is they've got more debt. However, he defends the bank and government, saying that monetary and fiscal levers have been pulled in response to the economic crisis and not in response to each other. Turning back to inflation expectations, Broadbent says that financial market expectations for rising inflation have barely moved. I don't think financial markets have shown any sign of doubting the integrity of the regime or the reasons for what we're doing. So some interesting thoughts in this interview on economic recovery, price inflation and interest rates. What do you make of his forecasts, of his comments? Let me know in the comment section down below. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.